Here is a summary of the U.S. stock market for the week of August 11th, 2025, and a preview for next week. This week, U.S. markets navigated a complex environment shaped by conflicting economic data. Major indices posted a second consecutive week of gains and even reached new all-time highs. But the rally was met with significant volatility. The initial optimism was sparked by a benign CPI, which suggested inflation was under control and bolstered hopes for an interest rate cut from the Federal Reserve. However, this positive sentiment was quickly challenged by a surprisingly high PPI, which revealed that inflationary pressures are building for businesses. This has created a critical debate. Will companies absorb these rising costs, or will they pass them on to consumers? This uncertainty has complicated the Federal Reserve's path forward, making the outlook for future rate cuts less clear. Let's examine the performance figures for the week ending August 15th. It was a positive week across the board for the major equity indices. The Dow Jones Industrial Average was the strongest performer, gaining 1.7%. The S&P 500 followed with a solid 1.2% advance, while the tech-heavy Nasdaq Composite rose by 1.1%. This broad-based rally indicates that despite some of the underlying concerns, investor sentiment remained positive throughout the week. This chart illustrates the narrative of the week. The market began with a modest dip, but then staged a sharp rally on Tuesday and Wednesday, driven by the positive inflation news from the Consumer Price Index. This rally was strong enough to push the major indices to new record highs. However, you can see the momentum stalled toward the end of the week. This was a direct result of the Producer Price Index report on Thursday, which was much higher than expected. That report tempered the market's enthusiasm and led to a slight pullback as investors began to question the likelihood of a near-term interest rate cut from the Federal Reserve. Now, let's take a deeper look at the most important economic story of the week, the divergence between the different measures of inflation. This chart visualizes the year-over-year trends for CPI, which tracks consumer prices, PPI, which tracks producer or wholesale prices, and core PCE, which is the Federal Reserve's preferred measure of inflation. As you can see, both CPI and core PCE have been trending in a relatively contained manner. However, the red line, representing producer prices, shows a dramatic spike upwards in the latest reading for July. This is significant because the PPI can be a leading indicator, meaning it can signal the future direction of consumer prices. The key question this divergence raises is whether businesses can continue to absorb these rising costs. This week, we saw clear evidence of the strain that producer price inflation and trade tariffs are putting on companies. For example, Tapestry, the parent company of brands like Coach and Kate Spade, saw its stock fall after it cut its profit outlook, citing the negative impact of tariffs. Similarly, agricultural giant Deere and Company lowered its forecast, pointing to a challenging environment. At the same time, we're seeing some evidence of these costs being passed through to consumers. For instance, airfares rose in the last CPI report, and airline stocks performed very well. The takeaway is that the period where businesses could absorb all of the rising costs appears to be ending. Given the pressure on businesses, there is speculation about potential responses from the White House to alleviate the burden of tariffs. While a broad subsidy program is considered unlikely, a review of past actions suggests a few possibilities. The first is granting targeted tariff exemptions to specific companies or industries, often in exchange for public commitments to invest domestically. Another approach is strategic de-escalation, such as temporarily pausing or delaying new tariffs to manage market sentiment. Finally, we may see informal pressure, where public platforms are used to discourage companies from raising prices on consumers. It's important to note that these actions create an environment of policy uncertainty rather than a predictable support system for businesses. Another critical piece of the economic puzzle is the labor market, which continues to show remarkable resilience. The latest report on initial jobless claims, which measures the number of people filing for unemployment benefits for the first time, remained near historical lows. A strong labor market is one of the Federal Reserve's primary objectives, known as its dual mandate. With employment remaining strong, the Fed feels less pressure to cut interest rates to stimulate the economy. This robust employment data, combined with the high producer price inflation, serves as a powerful argument for the central bank to remain patient and adopt a wait-and-see approach, which in turn reduces the probability of a September rate cut. The U.S. consumer is currently sending mixed signals. On one hand, spending remains resilient. The latest retail sales report for July showed a solid 0.5% increase, driven by major promotional events and auto sales. However, there are underlying signs of caution. For example, spending at restaurants and bars, which is a key indicator of discretionary spending, actually declined. On the other hand, consumer sentiment took a sharp turn for the worse. The main driver for this drop in confidence was a jump in consumers' expectations for inflation over the next year. In short, while consumers are still spending, their confidence is being eroded by the fear of rising prices, and they are beginning to pull back on non-essential spending. Amidst all these conflicting signals, the Federal Reserve remains focused on its preferred measure of inflation, which is the personal consumption expenditures. The Fed prefers the PCE index over the more commonly reported CPI for a few key reasons. It covers a broader range of spending, it dynamically adjusts for changes in consumer behavior, such as substituting a less expensive item for a more expensive one, and its data is revised over time, allowing for more precise analysis. The next release of the PCE data is scheduled for Friday, August 29th, and it will be a critical data point that heavily influences the Fed's next policy decision. This week's corporate earnings reports provided a clear illustration of the market's current mindset. Forward-looking guidance is far more important than past performance. We saw several instances where companies reported strong earnings that beat analyst estimates, yet their stocks fell sharply because their outlook for future quarters was weaker than expected. For example, Applied Materials, a key player in the semiconductor industry, beat expectations on both earnings and revenue for its third quarter. However, its stock plummeted because the company signaled a potential slowdown ahead. This pattern was repeated across several companies, underscoring that in this uncertain environment, the market is intensely focused on the future. Looking ahead to the upcoming week, the market is poised for a pivotal moment. There are 3 key themes that investors will be watching closely. First and foremost is guidance from the Federal Reserve. The release of the minutes from the Fed's last policy meeting on Wednesday, followed by the influential Jackson Hole Economic Symposium starting on Thursday, will be scrutinized for any hint about the future direction of interest rates. Second, we will get our first real-time look at the health of the economy in August with the release of the preliminary Manufacturing and Services PMI reports. And third, the consumer will be under the microscope, with earnings reports from retail giants like Walmart and Target providing critical insights into spending behavior. Here are the key dates for investors to have on their calendars for the week of August 18th. On Wednesday, we have the FOMC meeting minutes. On Thursday, we get the weekly update on initial jobless claims as well as the important flash PMI reports. Also starting on Thursday is the Jackson Hole Symposium, which will feature commentary from central bankers from around the world. On the earnings front, we will hear from several major retailers, including Target on Wednesday and Walmart on Thursday. These reports will be crucial for understanding the health of the U.S. consumer. So, how should an investor navigate this complex market? Here are 4 strategic takeaways. First, recognize that the inflation narrative has shifted. The risk is no longer just a simple economic slowdown, but a more challenging environment of slowing growth combined with persistent, cost-driven inflation. Second, the Federal Reserve is in a difficult position. The conflicting economic data makes a decisive policy move less likely, which will probably lead to continued market volatility. Third, keep a close watch on the consumer. While spending has been resilient, the sharp decline in sentiment is a significant warning sign. And finally, understand that in this environment, a company's forward-looking guidance is the single most important factor driving its stock price. This concludes our weekly market debrief. Thank you for joining us, and we wish you a successful week of investing.